You wake up in January 2009. The global economy is in chaos. Banks are collapsing. Families are losing their homes. Governments are spending billions to rescue financial institutions that many people blame for creating the crisis. You turn on your computer and enter an online cryptography forum. Most of the discussions are technical, confusing, and almost impossible to understand. Then you notice a message from someone using the name Satoshi Nakamoto. He has created a new electronic cash system called Bitcoin. It does not require a central bank. It does not need permission from a government. Transactions can move directly from one person to another through a decentralized network of computers. At first, you think it sounds ridiculous. Digital money already exists inside banks. But this is different. Bitcoin has no company headquarters, no chief executive, no customer support department. Nobody can simply create unlimited coins whenever they choose. You download the software. The program looks basic. There are no colorful charts, trading applications, or cryptocurrency influencers telling you what to buy. There is only a wallet, a network connection, and an option to generate coins using your computer. You click it. Your processor begins solving mathematical problems that help verify transactions and secure the network. Because almost nobody else is mining, your ordinary computer begins receiving Bitcoin in batches. 50 Bitcoin, another 50, then another. After several months, you control thousands of coins, but they do not feel valuable. You cannot use them to pay rent. Your local grocery store does not accept them. There is no popular exchange where you can instantly convert them into dollars. Your friends laugh when you explain that your computer is creating internet money. Some tell you to delete the program before it damages your machine. You almost listen. Then, May 2010 arrives. A programmer named Laszlo Hanyecz offers 10,000 Bitcoin to anyone willing to purchase and deliver 2 pizzas. Someone accepts the offer. For the first time, Bitcoin has bought a real physical product. You stare at your wallet differently now. Yesterday, those numbers represented an experiment. Today, they represent something that can be exchanged for food. Small marketplaces begin appearing. Bitcoin trades for pennies. Then it reaches $1. Your holdings are suddenly worth thousands. You consider selling everything. After all, how much higher could imaginary internet money possibly go? But curiosity stops you. You begin studying the system more seriously. You learn that the total supply is limited. You learn that transactions are recorded on a public blockchain. You realize that anyone with an internet connection can hold and transfer value without opening a traditional bank account. Then Bitcoin begins its violent journey upward. The price reaches $10. Then it collapses. It rises again. Then an exchange is hacked. People lose money. Governments issue warnings. Journalists announce that Bitcoin is finished. You watch the value of your wallet rise and fall by amounts greater than your yearly salary. Every crash feels like the end. Every recovery feels impossible. By 2013, Bitcoin is worth hundreds of dollars per coin. Your once useless collection is now worth more than your house. Family members who laughed at you begin asking how they can buy some. Strangers online claim the price will rise forever. Others insist the entire system is a scam waiting to collapse. You sell a portion. You pay your debts. You place some money into traditional investments. And you keep the rest. Then comes 2017. Bitcoin enters mainstream conversation. News networks display price charts. New exchanges attract millions of customers. The price approaches $20,000. Your remaining holdings are worth a fortune. But just as excitement becomes uncontrollable, the market collapses again. The price falls dramatically. People who invested money they could not afford to lose panic and sell. Some disappear from the industry forever. You finally understand that owning a successful investment does not automatically make you a successful investor. You still need emotional control. You need security. You need a strategy. And you need the ability to survive uncertainty. Years pass. Bitcoin returns. Large companies begin discussing it. Investment firms create regulated products connected to it. Governments debate how it should be taxed, controlled, or incorporated into existing financial systems. The strange software you downloaded in 2009 has become a globally recognized digital asset. But your journey has not been perfect. You lost coins when an old hard drive failed. You nearly entered your password into a fake website. You watched exchanges collapse while customers were unable to recover their funds. You received messages from scammers promising guaranteed profits. Your greatest advantage was not simply buying early, it was learning early. You studied how the network worked. You protected your wallet. You avoided borrowing money to chase the price. You sold enough to improve your life while keeping exposure to the possibility of future growth. Now, as you look back, everyone focuses on the fortune. They calculate how much 10,000 Bitcoin could be worth. They imagine the cars, houses, and freedom. But they ignore the years of fear, doubt, crashes, hacks, temptation, and uncertainty required to hold it. That is the real lesson of buying Bitcoin in 2009. Life-changing investments rarely look safe when they are still early. By the time everyone agrees an opportunity is obvious, much of the greatest growth may have already happened. But this does not mean you should throw your savings into every new cryptocurrency. It means you should become an investor before an opportunity appears. Learn how industries work. Study technology before studying price charts. Understand the risks. Diversify your money. Avoid projects built only on hype. Never invest funds needed for rent, food, emergencies, or debt payments. And when you discover something with real utility, strong fundamentals, and long-term potential, consider building a position gradually instead of waiting for perfect certainty. You cannot return to 2009. You cannot mine 50 Bitcoin from an ordinary laptop. But every generation receives new opportunities that initially look strange, risky, or unnecessary. Artificial intelligence, robotics, biotechnology, clean energy, digital infrastructure, and technologies that may not even have names yet. The next Bitcoin may not be another cryptocurrency. It may be an idea people are currently laughing at. Investing is not about predicting the future perfectly. It is about preparing yourself financially, studying what is changing, and taking calculated risks before the entire world recognizes the opportunity. Start small. Research deeply. Think long-term. Because you may never buy Bitcoin in 2009. But today could still be early for something.